Thank you very much for the introduction. I'm very happy to speak here today. This paper, which I will be presenting, is a working paper, so it's not published, and we very much welcome your comments. It's a joint paper together with Duchin, who will speak right after me on a completely different issue. So yeah, our research interests are quite diverse. And it's also a joint paper with two colleagues from Beihang University and two further colleagues from SOAS, so it's quite a big research team. We were also shifting quite tremendously in topic from microcredit to a more macro topic, and with a particular focus on modelling or measurement. So let me explain what the motivation of that was. And this is the motivation of the paper, not necessarily the motivation of the research project. So I will kind of zoom into the particularities of the paper first and then zoom out with the bigger picture of what we are actually doing here. So the paper is motivated by starting with a pretty kind of standard, super simple. We're trying to keep it as simple as possible because that's not necessarily our main interest. Standard money demand equation using only narrow money. So M being narrow money, being dependent on some sort of economic expenditure, usually measured by GDP, which is Y, and then the domestic interest rate, which is R. So now the problem is that's a closed economy baseline money demand equation, right? So now what happens if we move from a closed economy context into an open economy context, right? Then once you have an open economy, open capital account, then if you have the domestic interest rate in there, you're also missing out on, would need to account for some foreign interest rate, which is our R star in the second equation here. So people who in your domestic economy would be able to arbitrage with any other economy. They can invest if the interest rate is higher or lower. They would arbitrage the difference between the two interest rates, right? Accounting for exchange rates. So any assets, foreign traded, domestic traded assets have to be taken into consideration together rather than separately. Now, what happens most of the time is that, of course, the foreign and the domestic interest rates are correlated, which means if we do one and only account for the domestic ones, we're ending up with what you could call omitted variable bias and also an incomplete model. So if you're a central bank or any kind of macroeconomist, you would be interested in the elasticity of your money demand with respect to interest rate, right? So if the two are correlated, if you don't account for foreign opportunity costs, if you want, or investment opportunities, and the two are being correlated, that would mean that the coefficient or the elasticity coefficient would not be precise. So the quest here is find an appropriate measure for our R star or R asterisk. Now, so this is basically the narrative of the paper, which is dealing with money demand. However, the approach we are suggesting in order to find an appropriate measure for R star is something that is much bigger. So that kind of like measurement problem or measurement issue that you're seeing here, so it's both a question of measurement and a question of aggregation, right? So you want to find a way to aggregate foreign financial market data in order to come up with an R star, while at the same time you contain the disaggregated data, which is quite interesting for you as a macroeconomist because you want to know what's actually the most, let's say, or the predominant channels of asset classes that would influence money demand for your domestic economy. Now, that same problem could be relocated to other kind of open economy stories in a macroeconomic context because it's not only money demand that has foreign effects, right? So we can easily think about other contexts in which the same question of aggregation, disaggregation and measurement would come up. So money demand here being just our example. Shifting from the motivation of the paper to our model, we start super simple with an error correction model, something that is well known for most macroeconomists. And again, we're translating basically our equation number 1 and equation number 2 into error correction models. Right, so that's all we're doing, and the blue bits here, our R star, is the difference between model equation 3 and equation 4, and our foreign opportunity cost effects are being accounted for in model number 4, but we have a closed economy model in model number 3. Okay, so now the question becomes, how do we construct a measurement for our R square? And we call, not R square, asterisk, or the foreign opportunity cost effects, and we call that measure that we're coming up with as a composite international financial index. So it's an aggregate index that provides a composite measure or composite measurement. So it contains the different elements of different international financial markets, aggregating them in some way together so that we come up with an index. So replacing our, if you want, latent variable, which was our foreign opportunity effects, with another variable, which is now our measurement. So just replacing this to make sure we're dealing with a measurement now and not with a latent variable, we replace that with F. That's all the difference between model number 4 and model number 5. So very simple here. Now, in order to come up with that CFI, as we call it, we thought, or we referred a lot to different sorts of literatures. One literature talking about measurements, so most of this is inspired by literature from psychometrics. So psychologists have to deal a lot with the theory behind measurements, because most of the variables they're dealing with are latent, which is something that refers very nicely to the previous talk we just heard. So aspiration, for instance, being a latent variable, so you need to find ways how do you actually measure aspiration. The other literature we're dealing with, or we consulted in order to come up with, in the end, an algorithm that would construct our CFI measure, is supervised learning, or which is kind of something that is familiar to those who are dealing with machine learning, but supervised learning studies also is something that is very much rooted in statistics. So we combine unsupervised learning techniques and supervised learning techniques, as well as the insights from measurement theory, in order to construct our composite international financial index. So since we're doing, having a supervised learning strategy, for any supervised task or supervised learning task, you need a target, right? So whatever measure you come up, it has to be target on a variable in order to be supervised. Looking at our model number 5, we can identify 2 different targets that would be possible as targets for our algorithm. One is being our change in money demand, so the dependent variable on the first line. The other one is our error correction term. Yeah? So error correction term being our long-run disequilibrium, if you want, and then money demand being our short-run dependent from our ECM. So that's classic ECM with a long-run and short-run component. Using these 2 different targets also gives us 2 different CFIs, yeah, or CIFIs. One is being a short-run version. That's relevant for our change in money demand. The other one being a long-run version. And they will behave very differently, as we will see. Now, this is our basic visualization of the algorithm we constructed in order to construct our measurement. So we have 4 different steps. Right? So we start out with a broad overview of international financial market indicators, and from these individual variables, we construct disequilibrium indicators. What do we mean by that? Usually they are ratios or differences in order to capture disequilibria in the international financial markets. Yeah, so that's what we're doing, which we call at the input indicator construction step. So all we're doing, we're collecting all the input variables and constructing disequilibrium indicators. These will be our input features into our algorithm. Second step is redundancy reduction. This is an unsupervised learning step. Why? Because all we're doing is we're looking just at the input features themselves. So some input features might reflect the same financial market shock, the same disequilibrium, so on and so forth. If you would have all of these input features, and some of them would actually reflect the same shock or the same disequilibrium, once we aggregate over all of them, we would give unduly weight to that one disequilibrium or shock. So in order to give all of the different shocks that we observe in the international financial market the same weight, we have to reduce redundancies. Yeah? So that's what we're doing in the second step, and that's what we're using different clustering methods in order to do that, and then aggregating by just taking the average over those that are consistently across different time periods in the same cluster. So we can be sure that they reflect a common shock. The third step is where the most juicy bit of the whole algorithm. So that's the supervised learning part of the construction of our indicator, which is based on partially square or partial regression analysis. So those of you who working partially square is used a lot in management studies, less so in economics, but it's a partial regression type of analysis. So it's a regression analysis, which means we do have a target, right? We have a targeted variable. Why is that so important in the context of our money demand or the context of our open economy? If we take two very different economies, we would assume, let's say we have one large, relatively less open economy, and we have one small, very open economy. The index of the international financial market shocks that would be relevant for these two economies, we would expect them to be very different, isn't it? So since we have two different economies that are very different in their macroeconomic setup, we would expect two different indices to result from, or to be useful in order for macroeconomic modeling. The difference here can only be achieved if we have a target. If you don't have a target, if we aggregate over the same input features and we don't have a target, then of course we get this exactly the same indicators, yeah? Or index if you want in the end. So now the targeted approach results in a tailor-made index construction in the end. So that's the important bit. And as I said before, we have a short-run target, we have a long-run target that immediately emerge from our error correction model. The fourth step is something that's very important, and also that comes from a measurement literature, which is a concatenation operation. What does that mean? Every index needs updating. If you think about price indices, right, any price index, the basket of goods will be updated over time. So the same will have to happen to any index that survives in the long run or to be useful for modeling. You need to be sure that your index is being updated. However, at the same time, that updating needs to be prevented from altering past results. Yeah? Otherwise, you don't have a measure. If you go or update, if you have another year, you want to update your index, and then you construct a completely new index, that means you have a completely new model. That doesn't work, right? So you have one measurement that you had here, then you make another measurement, and that measurement will be added to the past values. Yeah, that's a fundamental property of in measurement theory, and that's what we impose here as part of our algorithm as well, yeah, for our index construction. I will be quick with the data bit and to leave us a bit more time for the results. So what we dealt with, from our kind of large, relatively not so open economy, that is what we used here. The People's Republic of China was our example here, and our small open economy is Taiwan Province of China, TPC. So we use these two very different economies in order to have a good comparison case. In order to construct our disequilibrium indicators, we use 180 raw financial market variables and construct these disequilibrium indicators for the 21 economies that constitute the major trading partners for these two economies. If you're interested in the exact construction of these, it's all in the paper. Okay. A couple of key observations. What we did first is we divided our modeling exercise into a training and testing period. So training is in order to find the model, then testing, and that was before the global financial crisis, and then testing the stability of that model post-crisis. Yeah, so that was our overall aim. I will jump ahead a bit because I only have 5 minutes left. So we'll go straight into both the calibration and the post-crisis crisis period, which is the more interesting bit. Two observations with respect to calibrating both the index and the model. So China, a little bit of backstory. Over the global financial crisis, China intervened quite heavily in and recalibrate or change the political setup of its macroeconomy tremendously, because they went back to a packed exchange rate and closed the capital accounts almost completely. Yeah, so that was the response over the global financial crisis, while Taiwan did nothing. Taiwan witnessed a massive reflux of their domestic investors who then were jumping into safety from the US markets, so they saw a massive reflux of liquidity coming back to their own domestic economy that wasn't sterilized, that money was just allowed to flow back. So two very different approaches. One, no reaction or policy intervention at all. The other one, massive policy intervention. Two observations with respect to both our model and the performance of our index in these models. First, one thing that was very important, apparently, is that the updating or the time of when we update or concatenate our indices, that had to coincide with when the crisis would hit the macroeconomy, or in our case, money demand. Yeah? So if you didn't synchronize that, so if at the time when that happened, you didn't update, then the model become very unstable. So that had to be synchronized, yeah? The updating with the time of the crisis. The other one is that for the Taiwanese case, our model was very well behaved and performed very smoothly, was very stable. While for China, when it went into almost a closed economy kind of setup again, it moved back from an open economy into a closed economy, that disrupted our long-run index, in the sense that it appeared that over the period where China closed itself almost completely, that the long run of our closed economy baseline model was working or behaving better than our open economy ECM, which had the CFIs or our indicators included. That wasn't the case for the short run. So our short run index was stable and significant throughout. So it's only the long run setup of the economy that was affected. So what we needed to do is we needed to ensure what's called co-breaking of our long run. Yeah, so we needed to align the policy caused breakpoint of the macro variables that were in the long run to co-break with our index. And that's exactly what we did. So we imposed that basically. Now, imposing that led to, for both economies, to have very stable coefficient estimates through repeated updating throughout the testing period. And also what we did is we compared our CFI augmented model, if you want, with the closed economy baseline model, and also with an alternative model that would just use US interest rates as a measure of opportunity cost due to openness. Yeah, so that's something that's done very often in macro modeling, to just use the US interest rate. Our CFI models outperform these models by far, and this is what you see here. So these are modeling encompassing tests of the two models. Our CFI models outperform both the US model and the closed economy model throughout both the training period, which is the left-hand side, and the testing period, which is the right-hand side. I will not go into much detail, but one advantage of the way we construct our index is that while we aggregating in order to use that as a variable, the index as a variable in modeling, we can also go back to the disaggregate data. And that's where it becomes very interesting, because we can look at the loadings with which different financial market features of disequilibrium enter the index. And as I said, the index is very different for the two economies, which also means that the weights or the loadings with which these disequilibrium input features enter the index are quite different across the two economies, which for a central banker might be very interesting, because it tells you which are the main channels through which these shocks affect your domestic money demand. So you can basically disaggregate again and then identify which are the main transmission mechanisms, which can be very useful in different contexts. To conclude, we can find a stable money demand equation. This is something that was kind of also a key motivator, which I kind of forgot to mention. Key motivator that often, especially in emerging markets, once economies open up and develop more mature financial markets, that you see empirical instability in the elasticity coefficient. That's retained if we adequately account for the effect of opportunity cost due to openness. So it's once you calibrate the model towards an open economy model, we achieve stability. The policy intervention of the People's Republic of China meant that we did need to recalibrate the model itself, while the global financial crisis shock didn't require any such calibration. All that happened is that we needed to update or concatenate the index appropriately in order to incorporate that shock at the time when it actually happened. Last point is that once you look at the disaggregate picture again, so you constructed your index, so you look at the disaggregate, that would potentially give you a nice overview over contagion, risk of spillover, and so on and so forth. So there's a whole kind of area that might be interesting for policymakers. That's it.
Okay, so question time, anybody? One up there.
Yes. Well, it's a very appealing type of technology. The question is, well, is it applicable to China or not? And this is maybe where we could have a little bit of a, well, pinch of salt or something. Because we know that actually the portfolio, the choice of, the financial choices of households in there are a little bit different from, well, what they could be in Taiwan, for instance. We know that Chinese households have no access to the bond market, for instance. So I'm sorry that maybe I didn't, I was not quick enough to look at the list of variables you have in your F index or whatever you call it. So did you have the stock returns in China itself, or, and why not? If not, why not? Because the normal behavior would be to go from a bank deposit to the stock market or maybe the housing market. That's a true choice of households. And maybe you have these missing variables alongside your favorite index. So I don't dispute the fact that this is a very nice piece of work and it might produce something, but you have two missing variables, which is domestic stock returns and returns on the Chinese real estate market. So I think maybe you should add one or two extra co-authors.
Should we collect or? Yeah.
Again, I didn't read the paper. This may be off, and it's not the question. I'm drawing it not from the countries you're analyzing, but I'm thinking if your interest is to look at a measure of opportunity cost, foreign opportunity cost. I'm thinking if when say somebody who is thinking about their portfolio in Ghana, Burundi, and so on, and they're thinking about, again, external factors in deciding how much cash they keep in their portfolio versus putting it in interest-earning assets and other things. Are they thinking more primarily about the interest rate in the U.S. or the exchange rate of the dollar versus the CD and the Burundian franc? I bet you there are very few Burundians who know about the interest rate in Burundi, but almost everybody knows about the exchange rate. So I'm wondering why you chose the interest rate and not other things, or whether it is included again in the CIFI, which I'm not. Again, like the other colleague, I didn't have a chance to see what's included there. It's included?
Yeah.
Okay.
But I will answer. Let's collect one more, if you have one more, and then I'll answer. So.
Anybody else? Okay, just go ahead. Go ahead and,
Yeah?
and answer.
Okay, let's be quick. Yeah, sorry, I had to run through it a bit also because there's a lot of information, and I appreciate your comments very much. Whether it's applicable to China. So 2 points on your comments. One is we're dealing with M1, so only narrow money, not M2. The other one is what we measure is opportunity cost due to openness. Right? So in our index, we're only using foreign variables. There are no domestic financial variables in that index. So what we really want to measure is, or have an insight in, what are the transmission mechanisms of foreign shocks to the domestic. You could, of course, come up with a model where you have the domestic housing market and then construct an index for the foreign shocks on the domestic housing market. That would be very interesting as well, potentially. And also, I mean, yeah, China is always a special case, right? So it's difficult to say to generalize any of these results, and it has changed quite dramatically also with respect to financial openness over the last decades, as we all know, plus the period of the global financial crisis where there was this heavy intervention, which also meant that we had to recalibrate the model precisely because of that, because the openness criteria was not there anymore. That's also why we also used added Taiwan, which is kind of a classical case of a small open economy, price taker, and that would have been kind of, it's a nice contrast between the two economies because they're two very different cases. The point on the exchange rate, yeah, that's exactly what's in the index. So that's something I should have mentioned, I'm sorry. So we have the foreign exchange market, we have the futures markets on the stock and the commodities, we have the stock markets, so equities, we have bond markets, money markets, and the banking sector. So foreign banking sector liquidity also seems to be one of the main transmission mechanisms, especially in the short run. So these factors are in that index, so anything that has to do with arbitrage between countries is captured by that index, because that's at the heart of it, right? The idea is if you have an open economy context, then potentially there's arbitrage to be made. And of course, it's not only the interest, it's any sort of asset class that is foreign or domestic, while we're only looking at foreign in that particular index. Yeah? So that's the idea behind it. So it's a very good question, very much to the point, and that's exactly at the heart of the index construction.
Very last question.
Okay, I would have said in the interest of time, but
thank you. So thank you, Sophie. So I'm sitting here and I want to advise a non-minister in Uganda or Ghana. What are you saying about the role of monetary policy? I mean, what do I tell them? If they ask me, you work for the African Development Bank, give us some advice, and I've just come from this conference. Thank you.
good question. Give me the data and I will have a good look. Plus read up.
Are you saying that openness is a bad thing because of the
No.
financial cost issues? What are you saying?
No. That's not the point of it. So the point is to basically identify vulnerabilities. And of course, if you have financial openness, you're more vulnerable. That comes with it, right? So any sort of, we have money outflow, we have capital flight, and we see that, and the risk of capital flight is tremendous, especially for a small open economy. So yeah, there is a risk to openness. But the point of the paper, our measure, is basically to measure the opportunity cost effects and also to identify foreign shocks to the domestic economy. But that's only on the example of Taiwan and China. Uganda and Ghana would be very different. I know a bit about Ghana, so I'm very happy to look into this. Uganda, I will really have to read through the last 100 years.
Any country, small, big economy, small, whatever. It could be Ghana, it could be Nigeria, it could be anybody. So I was just trying to, if I was asked to advise a finance minister, what would I be saying after listening to you? That's what's really my question.
Okay.
Give me the data and I will identify
Exactly.
I will look at the...
All right. Good round of applause for her on that note.